Hello friends, James Stephenson. It is game day. Tesla earnings come out this afternoon. So if you're looking for a Tesla finance related activity to kill some time between now and 4:20 p.m. Eastern, when Tesla releases the Q4 earnings results, this is the catnip for you. Speaking of catnip, let me adjust the Loki cam here to get Loki's face in the shot. There he is. Actually, I should just lower this camera some so that when I switch to the other view, you'll still be able to see his face. This is what I mean. There he is, right above the script, Loki cam. I didn't want his face to get covered up by the label on that view. And normally, if you're a frequent viewer of my videos, you know that when I make a forecast, I like to do a series of short videos talking about each of the charts and tables in my forecast. And I can't do that this time because I am out of time. Tesla's going to report earnings later today, if you're watching this on Wednesday, and you ought to be. Because that's when I'm going to make the video public. If you're a Patreon supporter, you'll get it a day early, because I'll publish it today, Tuesday. But I can't do that this time, so what I'll do is one long video. I don't know how long this video is going to take to go through all these charts and tables. Probably a long time, you know, because you can just check the time scrubber on YouTube and it'll tell you how long this video takes. I don't script my videos or practice or rehearse them, so I don't know. And with that housekeeping note out of the way, I'm just going to dive into the content and talk about my forecast charts. So I put these out more than a week ago on Twitter in a long thread. It might have been a 30-tweet thread. I forget how many tweets exactly, but I start off with the pretty charts, and then I show the boring tables of fascinating numbers in black font against a white or gray background. Okay, what's this first chart tell us? Well, the title here says Tesla quarterly deliveries by model and site. Actuals through 2022, forecast, and unreported detail breakdown per me. Tesla reports S and X grouped together and Model 3 and Model Y grouped together, and they don't report by location at all, which is frustrating for people who forecast in that level of detail and would like to know how well we did. Tesla doesn't tell us, so we have to guess and do some reconciliation work and try to back into, using the information we have, what that detailed breakdown should have been. So here's Q4 2022 right here. So here's where we are along the journey, and here's where we're going. Continuing the uphill climb, Tesla's charts go up and to the right. I don't try to do that to them on purpose. If I were to be charting other companies, they don't trend up and to the right. But Tesla does. So let's take a look at, starting from the bottom, here's the Fremont Model S. This was the only vehicle Tesla sold prior to 2015, after they discontinued the original Roadster. And now you can see it is. I mean, for a while there, when it was going through the Plaid refresh, we weren't selling any of them at all. And then Model X, the lighter blue color here on top of the Model S, just came back together. And I'm not forecasting a ton more growth out of these, like I am with the Model 3 and Model Y production from other factories. Let's take a look at the Fremont Model 3. This is where North America gets its Model 3s from. Here's the Fremont Model Y. That's one of the places Tesla makes Model Y now, the other one being Texas, which you can see up here. I've got ramping up quite a lot. That's the pink one here. Then in Shanghai, they're making a ton of Teslas. The red one here is the Shanghai Model 3. The yellow one is the Shanghai Model Y. Then on top of that, I have what I'm calling a Shanghai robotaxi. Tesla has teased a small robotaxi at Battery Day, and I think they intend to make one, but they don't want to Osborne themselves by hyping it before it's ready to go. So I have that forecast to happen in mid to late 2024. We'll see if it actually happens at that time or if I have to push this forecast back some. Next, we've got Berlin. The purple here is the Berlin Model Y. Very low numbers currently, but that's expected to grow. And that factory will be producing a lot of vehicles over the next couple of years. Then I have a forecast in late 2025 for the Berlin Model 3 to happen, but that hasn't been announced by Tesla, so I'll change that forecast if it doesn't occur that way. Next, we talked about the Texas Model Y. I have Cybertruck on top of that. And then Semi, you can't even see except for this little bit of yellow shading right on top because the unit volumes for Semi are going to be so small. The announcement came out just this morning that Tesla is going to spend $3.5 billion investing in semi-production in Nevada. That won't be just for final assembly of Semi. If Tesla is spending $3.5 billion, probably most of that money is going to be spent on 4680 battery, cell, and pack production on site. It would make sense to do all of that under one roof. So that's what I expect there. And that's only the first chart in this video, so I need to pick up the pace on the other videos, on the other charts, if I'm going to keep this video less than several hours long. All right, Tesla Global sexy deliveries by quarter. This is just the S, the 3, the X, and the Y, paying off the most difficult joke ever that Elon Musk had to make, planning out the names for these 4 models. So check it out. Yeah, here's how that's been growing over the years. If you look at just those 4 models, Model Y is most of what Tesla's going to be selling in all future years for vehicles, among those 4 anyway. Now, maybe that small robotaxi has a chance of ramping up to some insane production level if it comes with a low enough price tag on it. We'll see. The next chart in my forecast model is this Tesla Global Deliveries chart of just Model 3 and Model Y. So I switch the axes on you here. So I've got time falling down the y-axis here, and then I've got the number of vehicles produced running across the x-axis here. So you can see in 2022, more Model Y than Model 3 production, and that's going to continue to accelerate as Berlin and Austin ramp up their Model Y production. Next, a chart here on total production and deliveries of all vehicles. So the red line is the production and the dotted line is the deliveries. You can see for most of Tesla's histories, these lines crisscrossed each other. You can tell I don't script these videos as I trip over my words trying to think of what to say next. And it's normal for these lines to crisscross over each other back and forth. Either you deliver more cars in a quarter or you produce more cars in a quarter. Probably you can't keep doing one of those for very long before it needs to switch up again. And the remarkable thing to note here, beginning in Q3 2022, is that I'm not forecasting for Tesla to deliver more than they produce for a long time. I've got this running to Q1 of 2024 before Tesla will deliver more than they produce. Why is that? It's because this is ending the wave. Ending the wave means higher and higher ending inventory balances every quarter going forward, or at least that's my forecast expectation. Not saying it's impossible that one of these quarters Tesla will deliver more than they produce. It's just a question of how much your beginning and ending inventory balances are, how many you produce, and what the most cost-effective logistics are to minimize the cost per vehicle delivered. That's what Tesla's accomplishing by ending the wave. They're saying no to paying extra to expedite deliveries of vehicles to get them delivered before the end of a fiscal quarter. That's just an arbitrary deadline to try to minimize ending inventory. And Tesla has reached a point where it gets very expensive to try to deliver everything you've produced. The more and more you produce every week globally, the harder it gets to deliver all of it by the end of the quarter. So they're smoothing out those deliveries. It's also making it easier on the delivery centers to not have to deliver so much of the quarter's deliveries during the last month of every quarter. So that's what's going on here. The next chart is showing adjusted EBITDA by quarter with the actuals through 2022 and my forecast following that. So this is still my forecast for Q4 adjusted EBITDA. I have 5.75 billion. We'll see what Tesla reports. And then I've got that growing into the future with a lot of FSD sales helping to grow this. Of course, the deliveries, the volume is going to help. The more cars Tesla sells, the more profit they're going to make. But also the better FSD gets, the higher the take rate ought to go, and the higher Tesla can raise the price of it. So the more of that happens, the more profitable Tesla becomes. And then you've got stuff like Megapack ramping, helping out, etc. Next, we've got a chart here showing how Tesla makes its average dollar of revenue. So if you take all the revenue by division, automotive sales excluding regulatory credits get their own block here, the orange. Automotive leasing in blue, the energy division in green, and then services and other in this tealish type color. This is what that looks like over time. So here we are in Q4 of 2022. Here's what I'm projecting, very similar to what we got last quarter. That makes sense. This is a smoothed chart showing trailing 12-month averages so that it doesn't hop around a lot and make it hard to read the long-term trends. So you can see I'm expecting energy to grow a lot as Tesla ramps up Megapack production. They ought to be able to sell a lot more of those from the dedicated factory in Lathrop, California. It's gotten a lot of attention lately. I'm not forecasting for that to be wildly profitable, but I am forecasting it to be a good business decision that Tesla made to help grow revenue from the Tesla Energy division profitably. So that's what that looks like. Here's chart 10, how Tesla spends its average dollar of revenue. So this isn't, this has more categories on it than the previous one did because not all of these areas produce revenue. So you still have automotive here. The automotive cost of sales is paired up with the automotive revenue you saw on the previous slide. Then we have the energy division here. These costs are growing as the revenue grows over time. Services and other here. All of these are getting pushed to the left by the green. What's the green? That's the non-GAAP earnings. That's the earnings before the stock-based compensation comes out, which is a non-cash expense. So the everything else, excluding stock comp, is also growing from really small numbers here in 2022 to bigger numbers in the future. What's Tesla going to be spending this extra money on in the future? Taxes. The bigger the non-GAAP earnings get, the more you have to pay in taxes, which is included in this everything else, excluding stock comp. But I do also show you the research and development costs, the selling, general, and administrative costs, excluding stock compensation. And that's what this chart shows. A lot of profits coming in the future for Tesla. The next chart here is showing Tesla non-GAAP earnings on a per delivery basis. How much profit does Tesla make per car they sell over the trailing 12 months? So up through Q3 of 2022, these are actuals. And then I put a box here to note that I'm including an estimated $2 billion in deferred tax benefits from prior year's losses. Tesla may not take this, so if they don't, these numbers will be lower, especially the Q4 and Q1 numbers where I've got those going. But then on a 12 trailing month basis, you would still see those impacts as part of the trailing 12-month average in Q2 and Q3, which is what the box is for. But then in the future, that number gets bigger and bigger. I hear some of you saying, hey James, Tesla reduced their prices by a lot. Shouldn't that have reduced the profit per vehicle a lot? And you would think that it would if you were just going based on back-of-the-napkin calculations. But you need a big, detailed forecast model to understand the reasons why the profit per vehicle doesn't fall by a lot. And it's because continued growth would have been occurring without those price cuts. Because Berlin is ramping up and becoming more profitable at greater economies of scale. Same with Berlin. You've got the fact that people weren't paying on average those higher previous prices in the first place. If you try to tie out Q3 numbers to what Tesla reported, people were not paying the previous prices. Tesla was still fulfilling a backlog of orders that were placed at lower prices, and then Tesla was raising prices so that they could work their way through the backlog and lower the prices, which they've done successfully. So that's been Tesla's pricing strategy. And there were also incentives in Q4 that kept this number down. And so that's why it's not going to be that big of a hit in Q1 and Q2 to profitability per vehicle. And it'll pop right back up after that. So it's good to have world-class profit per vehicle in the first place, to have the room to reduce some prices. Also, the vehicles Tesla reduced the prices on by the most were the vehicles Tesla doesn't sell many of. Model S, Model X, and the Performance Model Y were never very hot sellers in the first place. And the ones Tesla was selling a lot of got smaller price reductions. So all of those things together are explaining what's going on there. The next chart is just like the previous one, except that it throws out the revenue from regulatory credits, as some people like to do, or they like to do it back in 2019 when it made the number negative. Since 2019, that number hasn't been negative, which is what this chart's good for illustrating. But it is good for profitability to be able to sell regulatory credits to your competition who did not produce enough electric vehicles to comply with applicable law requiring them to. So Tesla should be heralded for producing extra EVs that those automakers can buy regulatory credits from. The next chart here is just an inventory, production, and deliveries chart. I can actually scroll through all the different vehicles that Tesla makes. So that's what Model S looks like. You can see the plaid refresh here really clearly. Same with Model X. You can see how low that production was for a while before it ramped back up to normal levels. Fremont Model 3 here, looking steady. Fremont Model Y seems to be looking pretty good. Roadster, I don't have any of in 2023. Better luck in 2024. So that's what the total Fremont looks like. Here's what Shanghai Model 3 production looks like. Here's Shanghai Model Y. I guess I should explain for each of these. The production is the orange number. The deliveries are the green bar. And then what are they sitting on top of? That's the beginning inventory and the ending inventory. The blue is the beginning inventory. The pink is the ending inventory. So you see these rising into next year as Tesla ends the wave. So what does this look like? It looks like more Shanghai produced Model Ys in ships being exported to their buyers in foreign countries. So Tesla is using Shanghai as their export hub. I don't have any Shanghai compacts being sold in 2023. Then here's total Shanghai. That looks pretty good. You can really see the inventory build there. Berlin Model 3s won't happen in 2023. Model Ys will. So really ramping up strongly throughout 2023 from very low numbers in 2022. No European model yet for a while. So total Berlin is really just the Model Y. Here's the Texas Model Y. Looks very similar to Berlin. They ramped about the same time. That's an error, which is kind of fun. I don't know why there's a Texas Cybertruck that looks like that. That's kind of interesting. And that's not right either. So I'll dig into what's doing that. But there's all the all sites and models combined together. The next chart we have here is about Tesla's 2018 CEO Performance Award. This is how much expense Tesla declared each quarter related to paying Elon his stock-based compensation bonus plan. You can see in 2022 these numbers have been small. If anybody expects any big numbers to pop back up again, I hate to disappoint them, but that won't happen because Tesla has almost reached the $2.283 billion maximum that could be paid out under that 2018 plan. The next chart here shows Tesla's average revenue per delivery. That's the mountain range in the back. You can see that falling over time and then stabilizing since 2021. Versus automotive gross margin excluding regulatory credits as a percent of revenue. Those are the bars that have the percentages labeled over the top of them. So that rose quite a lot during 2021. And then it was hampered in 2022 by stuff like the Shanghai lockdowns in Q2, dropping this number down quite a lot. And then just some startup costs for Berlin and Austin being at very low production rates made them have very poor gross margin. But the more they produce, the better their gross margins will get because the labor cost per vehicle produced comes down the more vehicles you can produce per hour. So I've got this improving. So in Q4, I've got it bottoming at the lowest number we've seen since early 2021, when Tesla pricing was very similar to what it is now, actually. And I'm also docking Q4 for some promotions that happened in China and in the US that brought the effective price down by more in the case of the US than where those prices are going to be in Q1. There was a $3,750 December delivery incentive in the US for a couple of weeks that then became a $7,500 incentive to pick up your Tesla early, and that's gone now. No more of that in 2023. So in my forecast, I've got us right back to a 25% margin almost in Q1, and then improving throughout the remainder of the year as Tesla gets more efficient at producing vehicles. All right. The next chart here is showing Tesla average revenue and cost of sales per cash delivery if you exclude the leased vehicles and the regulatory credits. So the red is the revenue per vehicle. The black bars are the cost of sales per vehicle excluding leasing. And the cash deliveries, this is your volume indicator, tells you how many units Tesla sells in each of these quarters. So in 2023, I've got Tesla unit sales ramping up to new records in every quarter, with Q4 being just a little higher than Q3. And yeah, you can see the cost of sales per vehicle being a little bit higher in Q4 than it was in Q3. That's what I'm forecasting. But then that cost of sales per vehicle coming down a little into next year as Tesla gets more efficient at producing more volume out of each of their factories. And then the revenue per vehicle has been falling since Q2. It was at a higher level, 55.9, That fell to 54.7 in Q3. I've got it falling to 53 flat in Q4. If you think it ought to be lower than this, you need to do the math. You need to break out all the different kinds of vehicles people could buy from Tesla's website around the world and then average those together. Yes, Tesla does sell some vehicles that start at a price below 50,000, but not a lot lower than 50,000. And when people buy those vehicles, they can option them higher based on paint and wheels and interiors and all the stuff you see in my forecast, right? And Tesla is still selling Model S and Model X at higher prices, you know, Model Y performance, etc. Lots of vehicles starting way above 53 grand. So this is how I see margins improving in 2023, rising revenue per vehicle, falling cost of sales per vehicle. That makes sense, I hope. We're getting closer to the end of the charts here. Tesla quarterly revenue, regulatory credits revenue. There was this one really big record high quarter, Q1 of 2022. I'm not forecasting anything like that to happen again, but it could. This is a huge wild card. We don't know how much Tesla's going to report for regulatory credits. So this is roughly what I'm forecasting. Which means the regulatory credits revenue per vehicle is coming down over time. I know you see the total dollar amount trending up, but it's growing by less than the units sold are growing by. Hope that makes sense. Here's a chart showing Tesla's next 12 months non-GAAP EPS, which is unadjusted here. And post the 3-for-1 stock split. You should hope so. That 3-for-1 stock split happened back in August, so I should probably just remove that from the label next time. So there's only one large circle on here, only one forecast, and that's because all of these are historical actuals except for this one, and this one is 3 quarters actuals. We're only waiting on one more quarter to include in the 4 quarters that follow Q4 2021. And that's the one Tesla reports today, if you're watching this on a Wednesday. So here's what I have forecast, $4.36 for the full year 2022 is what that means. Then the next one here is the... Come here, Loki. Oh, Loki is on patrol. Let's get him in the shot here. Oh, he's not active very often, but I guess I fired him up talking about Tesla earnings. So, oh, he really wants to let him have it. Okay, buddy, it's all right. Okay, let me answer my door. Hello. That's me. Thanks so much. Have a great day. Hello, buddy. Was that exciting? Okay, well, another first for the James Stephenson YouTube channel. What are we, half an hour into this video, and I answer my door? All right, buddy, you're okay. I took care of the person at the door. You're all right, little guy. Yes. Loki's just protecting the house, and he gets so fired up talking about Tesla EPS. That's the main thing. All right, so let me go back to sharing my desktop. Loki, I'll go back to sitting in his bed, I think. And I'll flip the hoodie back on the chair behind me and continue the tour. So pardon the interruption. But yeah, this is the same chart except on a log scale. So you can see it's going 25 cents, 50 cents, $1, $2, $4. So every time an equal increment is advanced vertically, it's doubling the amount of earnings, right? That's what's good to see a diagonal line here. A diagonal line across a logarithmic scale is giving you exponential growth. And you can see that slowed a little. Well, it's gonna slow a little. You can't have you can't have your EPS doubling on you every 3 or 4 quarters forever. It'll have to slow down at some point. But I do have continued growth happening, driven by stuff like, Megapack getting more profitable over time. Conservatively, I don't have wild expectations for how much it's going to contribute to earnings in 2023. Some people think it'll contribute $3 to earnings in 2023. I would be very happy if that happens, but a little shocked. That sounds like too much. You can see Tesla's only been making about $3 worth of EPS per year very recently, so that would be a bunch. I have less than that in my forecast, but I do have that being a profitable business for Tesla to be engaged in. I just have reasonable expectations for that Tesla Energy division. What's the next chart here? This is how much FSD revenue at time of purchase per delivery I have in my forecast. So you can see that number has been low for a long period of time through Q3 of 2022 actuals. This is my forecast for, $1,272 per vehicle sold on average. The take rate is very, very low in China right now, for example. So what you have to assume is that in the future, FSD, the feature, or the suite of features that drivers get, is going to be way more compelling in China in the future. And then at that point, when people are able to go on zero intervention drives to wherever they want to go, it's going to start selling a lot better. And so you'll see FSD revenue per vehicle increase by a lot. I did have this ramping up to a very high level by the end of 2024 in previous forecasts. If you remember what this chart used to look like, it would ramp up to here and then flatten out. I have pushed that to the end of 2025 in my most recent forecast. So I still have the ramping expectation. I just have it taking longer to ramp. As Tesla's FSD team continues to work relentlessly at making that product better. All right, the next chart here is global Tesla deliveries, 2018 through 2022. We do know what this number is because it's already been reported for Q4. 405,312, a new record, and by a lot, that's greater than 60,000 more vehicles than Tesla had ever delivered in any previous quarter. So Tesla continuing to ramp up. I provided a box over here for Tesla Q to fill in their 2023 forecast because they think the growth story is over and Tesla has fallen off a demand cliff. So you can provide this forecast to Tesla Q. Let them just pencil in what they think is going to happen in 2023 for these 4 quarters because they won't need more room than this if the growth story is over and Tesla has fallen off a demand cliff. The next chart in my forecast model shows a comparison of automakers, automotive revenue by automaker, 2020 versus 2021. We still don't have even Tesla's revenue here. Oh, buddy. Loki, come here. Come here, buddy. Come here. Yes. Love you. Love you. All right. Come here, little guy. Sorry for another interruption from Loki. He just gets fired up when he talks about how much Tesla's automotive revenue is growing by compared to the other automakers that are mostly flat. You can see at the bottom there, Great Wall, growing from a very low level indeed to a higher level. Looks like they're growing at the same clip as Tesla, but they're not. Tesla's growing revenue by more. And I will try to update this chart once we get revenue for all of these It would be awesome if Factory Warranty List would just provide an updated list for these same companies so that I don't have to look them all up individually. That would take a lot of time out of my limited time that I have to work on Tesla stuff. The next chart here is showing Tesla PE ratio, compression, and the range of PE ratios in each quarter. So this was a cool chart idea somebody shared with me on Twitter, so I made the chart. It's just showing, hey, what was the quarterly low PE and the quarterly high PE, and then the quarter ending PE for every quarter throughout Tesla's history. So here's what that looks like. And in Q4 2022, this got compressed quite a lot. We don't know what Q1 of 2023 is going to look like yet because we're not even 1 month into it yet. But here's how this looked. Pretty good deal on Tesla if you look at it on a non-GAAP, fully diluted, trailing 12-month basis, which is what I'm showing here. Okay. The next chart here is showing Tesla's operating expenses, what the actuals have been, and what I'm forecasting into the future. Broken down into restructuring and other, which doesn't hit every quarter. Some quarters it does. There's some Bitcoin impairments shown in here, and some layoff impacts that hit in some quarters but not others, which is why not all the bars are topped by a yellow block. Then below that you've got the CEO stock compensation, which ought to be 0 for the next few quarters at least. I'm forecasting that that'll go back to being a number again starting in Q3 of 2023, but who knows when the board will sign Elon to another long-term contract awarding him stock-based compensation for his services. In the meantime, Elon is working for free, having vested all of his stock compensation earned since the beginning of 2018. Then below that, you've got the SG&A stock compensation, the dark blue. The lighter blue is SG&A excluding stock compensation, the rest of the SG&A in other words. And the very light color here is the research and development. The next chart is just the SG&A components. So if you want to zoom in more on those, this is what those look like. Okay, here is my EPS. Let me zoom in here a little bit more. I think that's probably as good as I can get it. So do I need this? Yeah. So as of my January 15th forecast estimate, I zoomed in too far, you can't see the bottom. Well, let me see if I can scroll down a little bit. Okay, there it is. That's probably good. And I've got labels over here. So all other revenue is the top piece. Energy division is here. Auto revenue is here. So what's all other? It's the other and undistributed, other services and other division is what that is. So mostly Tesla's revenue is coming from automotive, including leasing. That's what I'm showing there. I'll scroll back over here. All right, so this is where Tesla makes their revenue per diluted share. So you've got, $7.50 worth of revenue per diluted share, and here's how it breaks down by division, mostly coming from automotive. Then how do they spend that? Well, most of it gets spent on automotive cost of sales, $4.87 per diluted share is what I'm forecasting for automotive. For energy, 37 cents against 45 cents worth of revenue. Then an even worse gross margin out of services and other, 59 cents worth of revenue, 56 cents worth of cost of sales. And then you still have to hit it with your headquarters type expenses. So research and development, selling, general administrative, taxes and other, restructuring and other. And that leaves you with the non-GAAP earnings of $1.48 per share after you've backed those expenses out. And then if you hit it with the total stock-based compensation of 10 cents per diluted share, that knocks you down to $1.38 of GAAP EPS. So that's what this chart is useful for, is showing you the GAAP EPS, the non-GAAP EPS, if you add back those 10 cents worth of stock-based compensation per share. And then I've noted the adjusted non-GAAP EPS of $1.03 if you back out the 45 cents worth of deferred tax asset benefit that I forecast in Q4. Either Tesla will declare that and I'll be right, or they won't and I'll be wrong. But either way, Wall Street would back it out as being a non-sustainable item. So $1.03 is the adjusted non-GAAP EPS estimate in my forecast. That's lower than what the Street expects, actually. So we'll see what we get from Tesla. Here's the Tesla GAAP net income / loss in billions. I made this chart because somebody called out, hey, Tesla loses money if you throw out regulatory credits from GAAP net income. And they said in Q1 of 2021 it was $100 million. Well, you know what? They were right. But look at every quarter since then. They've all been positive by much larger amounts. And it's growing over time, right? So that's what this chart's good for. And the next thing here is my detailed model. So this is certainly big enough for you to read, but we're all the way down to the income statement portion of this. So here's what I have in my forecast model for automotive sales, including regulatory credits. A little over $22 billion in Q4, which would be an all-time record. Same for leasing and resale revenue, an all-time record. So that's making total automotive, including leasing here, subtotal. Then you've got energy generation and storage. I've got a big increase here to more than 1.5 billion. We'll see what we get. Services and other, I've got cracking 2 billion for the first time ever. Used car prices were still okay. Come on, Loki Cam, get your act together. You gotta frame Loki. Let me just move this over. This is gonna be a long video, so I may as well just drop it over here where you can see Loki a little better and not have a bunch of stuff in the background you don't want to see. So there's the total revenue I'm forecasting, almost $26.5 billion. That would be a lot. So below that on the income statement, what's next? It's all the cost of sales that goes with those numbers. So those would total up to a gross margin percent for the company of 22.9%, including all of these different divisions. That's not just automotive. Making gross margin of $6 billion, which would be a record. I don't think Tesla has ever had a $6 billion gross margin quarter before. A quick scan of the previous quarters shows that they have not. Now that includes a currency translation impact of $420.69 million. And you might think that I backed into that number, and I totally didn't. I have the detail down below. You know what? This video is long enough. I may as well just go show you the currency translation impact section, which is going to be down below. Yeah, here it is. Okay, so foreign currency translation adjustment. I tried forecasting this in Q3 and used a method that I thought would work and was way low. The impact was a lot larger than what I was forecasting. So I am compensating for that miss from Q3 by applying a coefficient to my Q4 to triple it, basically, from what I would otherwise have been forecasting, because my Q3 estimate was about a third of the amount that it should have been. So here's the unadjusted revenue amounts for revenue and for cost of sales, which is what you need to estimate the gross margin impacts. Then I've got a yuan index here. So there's that coefficient that I was talking about tripling up on the methodology that I tried from Q3 that wasn't nearly enough of an impact. So I've got the exchange rate between the yuan and the dollar. The dollar was weakening in Q4. It had strengthened in Q3. So you've got these going in opposite directions here. It was unfavorable last quarter. It ought to be favorable this quarter. So I've got percentages of effective percentages for yuan currency translation for each of the revenues and the costs here. Then for the euro, it's the same story. The dollar's weakening, so I've got that tripled up here, and unfavorable last quarter ought to be favorable this quarter. Here's how much of the revenue from each of these sources that I believe would be transacted in euro currency and need to be translated. So I've got that running down the page. So after you've done all that math, you get the foreign currency translation impacts. So about $1 billion, $1.1 billion to the good worth of revenue, automotive sales revenue. A little bit from leasing, not that much. Then for Tesla Energy, maybe $150 million worth of impact, maybe $200 million worth for services and other. So that's how you get to the total revenue impact, about $1.5 billion to the good, because my estimate was not high enough last time for the gross margin that you see shown in Q3. Then you've got the cost of sales impacts here, which would take back most of the benefit that you get to revenue. So the total gross margin impact is going to be the net of those two. And here's that live calculation. I was kidding about it being 420.69. Unless I wasn't, let's run the decimal out and see. Okay, it's 420,890,000. So, not all that far from the joke meme number. Okay, so that's what's going on with currency translation. The impact ought to be favorable by a lot for Tesla. So let me run back up my model to where we were, which was the income statement. We made it as far as gross margin and the currency translation impact. So what's next? Research and development expenses. Those ought to rise. Not as high as they were in Q1, though. So I've got about $800 million worth of R&D. Then almost $1 billion worth of SG&A expense here in total. There's more detail below. Here's the $1 million that I made a separate video about, the Bitcoin impact. I just learned Tesla may declare zero worth of Bitcoin impact if they're allowed to implement FASB's most recent guidance already, that it's fine to hold your digital assets, your cryptocurrency, at market value instead of needing to continue doing impairment write-downs on the value of those assets that flow through your income statement like an expense anytime they trade at a closing price lower than your previous cost basis, meaning the price that you bought that cryptocurrency at or the previous basis by which you impaired that currency. All right, so that makes $1.8 billion worth of total operating expense, making income or loss from operations, its income from operations, of $4.3 billion is my expectation, at a 16.1% operating margin, which is worse than last quarter but better than Q2. With interest income rising to a little over $0.1 billion, and interest expense falling as it should, as Tesla continues to pay down their debt to lower and lower levels, strengthening their balance sheet every quarter. I have to forecast something here for other income / expense, so I've got $12 million worth there. Who knows what it'll be? Could be positive, could be negative. It jumps around. Then this is where I've got $1.6 billion worth of favorability, without which Tesla would be paying $1 billion worth of income tax on this $4.3 billion worth of taxable corporate income. making a net income or loss that's higher than the income or loss before income taxes. That's a contra expense I'm showing here for income taxes because there is a benefit that I'm forecasting Tesla will take. I'm just happy to be rid of it one way or another. I don't think Tesla would take it next year, given that they've got so much in the way of benefit coming from deferred tax or from the Inflation Reduction Act's benefits for producing and selling solar and batteries and electric vehicles. So that makes GAAP net income of $4.8 billion. That's what I've got in my forecast for Q4 anyway. We'll see what we get when Tesla reports it. Here's the shares outstanding basic, 3.177 already outstanding, and here's the diluted, including stock-based compensation awards that have not been redeemed yet. Most of the difference here being stock that Elon has earned. He's vested. The board has awarded him the option to buy, but he hasn't bought them yet. So those shares don't exist yet as basic shares. Then you've got $1.38 worth of GAAP earnings per share diluted, with the DTA amount being 45 cents per share worth of benefit in Q4. And then I'm forecasting another 11 cents worth of benefit in Q1 because I think you can't take more than 80% of the total amount of deferred tax asset in any single fiscal year, which is why I've been forecasting this as a Q4 and a Q1 activity every year for the past 3 years. And Tesla's never taken it yet, and maybe they never will. We'll find out when we get Tesla's earnings report. Here's the Tesla stock price forecast. If you think 30x is a good multiple for the next 12 months of adjusted EBITDA, that would make a $377 price target. That's sure a whole lot higher than where it is now. The trailing 6-month average stock price for Tesla as of Q4 2022 was $234.57. The trailing 6-month market capitalization for Tesla in billions was very high. Let's see what we have here. Yeah, if it's 235 times 3 billion shares outstanding, 745. That's a lot higher than where it stands at the moment. It dipped a lot lower than that. Then we've got highest CEO plan, market cap achieved. We've got some market cap, EBITDA, and revenue metrics here that were important for forecasting how much expense Tesla would declare related to that CEO compensation plan. Not all that important anymore, but we've got a bunch of rows dedicated to that in my forecast model. You can see that the total output of that is CEO stock compensation expense, and it's been a very small number for the past couple of quarters. And I'm forecasting it'll be the last $4 million worth in Q4 and then nothing next quarter and the quarter after that. Then we have the breakdown of SG&A by type here. So I'm forecasting $80 million worth of other stock-based compensation that records as SG&A, with non-stock SG&A of $909 million, making almost $1 billion of SG&A in total that we saw up top already. Then here's the breakdown of stock compensation that would hit other areas, cost of revenues for people who work at factories who get stock compensation, research and development for that area of the company. Hey, I misspelled research over here. I have to fix that. It's not research, it's research. And development. There shouldn't be any hitting restructuring and other, so that makes $336 million worth of total stock-based compensation in my forecast for Q4, which gives you non-GAAP earnings of $5.164 billion when you add the stock-based compensation back to the GAAP earnings, which is a 19.5% non-GAAP earnings margin, almost $1 penny, or almost $1 out of every 5 worth of revenue falling to non-GAAP earnings is what that's telling you. Then non-GAAP earnings per share diluted of $1.48, and then if you take out the 45 cents for the one-time tax benefit that'll get backed out by Wall Street, that would be adjusted non-GAAP EPS of $1.03. Then I've got a row here I've got a section here for PEG ratio. So what do you need for that? You need to know what your next 12 months of non-GAAP EPS is projected to be. That number keeps rising and will continue to into the future, I'm forecasting, with year-over-year non-GAAP EPS increase of $4. That's pretty huge, at an earnings growth rate of 92%, and I've got that rising. So yeah, Tesla's doubling earnings as time goes by, with a PE ratio based on the trailing 12 months of non-GAAP earnings of 54 as of Q4. If you do it based on GAAP earnings instead of non-GAAP, you get 60. And if you do it based on the next 12 months instead of the trailing 12 months worth of GAAP earnings, it's a PE of 30. That's very attractive. I've got that falling to a 24 PE in Q1, which is where we are living in the present moment. Q4 happened. Ancient history. The death of Julius Caesar and Q4 earnings are both ancient history as soon as Tesla reports them. Making a PEG ratio below 1. A 0.58 and a 0.42 PEG ratio. That's very attractive if you believe in the earnings that I'm forecasting above. Then a Peter Lynch PEG equals 1 price target of $401 at the current moment, and $561 in Q1 if you think this PEG ratio ought to be 1. Which is what Peter Lynch preached was a pretty good valuation metric based on earnings growth. You ought to be paying for future earnings growth. Stock prices are not a lifetime achievement award. They are a forecast of what earnings are going to be growing by in the future. That's what investors ought to care about. Then I have Stephenson indicator here. We ended the year in 2022 at $420.69. I'm going to keep making that joke. 421 is where it happened to shake out. So if I see that number, that's what I'm going to tell you the detail was. Let me take the decimal out just to show you that it's not. It's 420.67, which is as close as I could possibly get it if I were not trying to do it that way. Let's get rid of that again so you can see more of the screen. GAAP net income again. So here's a section that reconciles out to the adjusted EBITDA from GAAP net income. If you add back the interest expense, the income taxes, the depreciation, amortization, and impairment that I'm forecasting here to be a little over $1 billion in Q4. And then the stock comp we saw earlier is how you get from GAAP net income to adjusted EBITDA non-GAAP, with a 21.7% adjusted EBITDA margin. Then here I'm showing the automotive gross margin at 24.9%, including regulatory credits, or if you back out the 1.1 percentage points worth of benefit Tesla gets from regulatory credits that I'm forecasting, that would be 23.8%. Automotive gross margin excluding regulatory credits, which is down 3 points from where it was in Q3, before I have it popping back up again to about halfway between these numbers, 24.9% by Q1 of 2023. Here's a section showing total production and deliveries. So I've got increased production and increased deliveries planned in Q1. These are actuals, so you can see Tesla's ending finished goods inventory levels rising, and rising some more over time here, and this is how many of those were subject to lease accounting if you back into the number using what Tesla reports on their production and deliveries report, which is what you have to do until they report more detail. Here's my breakdown of where Tesla's revenue comes from by type. So if you think my 21.6 billion of total automotive revenue is high, here's the detail that runs behind that. Base config of 18.6 plus option types. A lot of performance package benefit in there, getting you to the cash buyer ASP, which is what the buyer thinks they're ordering when they place their order. Then you've got to back out the money you don't get from people who lease vehicles because they're not paying you for the entire sticker price of the vehicle. They're making payments for 3 years on a portion of that and then giving you the car back to sell. Yeah, Loki knows how lease accounting works. It's okay, buddy. Let me move this camera up so you can see what Loki's doing. Here's... You gonna come over and visit me, buddy? Okay, come here. Come on over. Okay. Alright, here's Loki. Loki's gonna help me talk through the leased vehicle accounting. So we've got... I accidentally hit a button. I need to undo and undo some more. There we go. So regulatory credits, I'm forecasting at 330 million of that. So these are all the adjustments you need to get from the cash buyer ASP to the total automotive revenue per vehicle. Stuff like destination and delivery fee isn't shown in the configurator, but everybody has to pay it, right? And that's serious money. That's $500 million worth of destination and delivery fees. I know you know it's real money when you buy a Tesla and you have to pay for it. So if you exclude FSD, leasing, resale value guarantees, and regulatory credits, this number becomes that number. $500 million worth of that stuff. Here's the deliveries. If you exclude the ones subject to lease accounting, total automotive cost of sales, dollars are here, gross margin percent, excluding FSD, leasing, etc., 22.9%. Okay, so the next section is giving you the same information except for cost of sales instead of for revenue. So that's what those do. And next you can see the cost of sales percentages by type, which is probably easier to understand than the raw dollars would be. With full self-driving having a cost, there is a cost of full self-driving. It's the variable cost that's zero that Sandy Monroe and I both mentioned in my recent video, and somebody questioned on Twitter. Yes, there is cost of sales for full self-driving. There is a whole FSD team that produces that software, so I do account for that cost in my model. It just doesn't increase by very much when one more person purchases FSD. That's what variable cost accounting is all about. Total revenue per delivery, cost of sales per delivery, revenue per fully diluted share. Here's how much the revenue per fully diluted share has been growing on a 12 trailing month basis as time goes by. So that number keeps getting bigger. That's good news. It's one of the reasons you would do a price cut is to keep growing your revenue. That's counterintuitive, but that's what's going to happen for Tesla next year. Here's the breakdown that I have in my model for total Tesla deliveries by site and by model. So you can see that breakdown here. We saw it in chart form earlier. And here it is by model if you add together all the Model 3s and all the Model Ys. S and X are only made at one location. Semi is only made in Nevada, and that'll continue to be true. I guess I have to update my labels from Texas to Texas/Nevada. So here we have total automotive revenue per delivery by model. So you can see what people are paying in total for these models. Yes, for Model 3, it's less than 53 grand, but for Model S and Model X, it's more. And for Semi, it's way more. We have to guess how much because we don't know how much Tesla is charging. So far, just Pepsi, I think, is the only person who's taken delivery of a Semi. They have a bunch at their Modesto, California distribution center now. Revenue per delivery by type. So you've got that info here, which is fun to look at. FSD sales plus other revenue. GAAP earnings per delivery, non-GAAP earnings per delivery, adjusted EBITDA per delivery, and EBIT per delivery. So that's good info in my forecast model. Here's the 12 trailing month deliveries. So Tesla continues to grow this figure as every quarter rolls by. They're upping it by about 100 million, not 100 million, 100,000 deliveries, because this is in millions. I'm used to looking at the billions of dollars above. 12 trailing month revenue in billions keeps rising as time goes by. That's good. That's what you want. And the EBITDA as well. Here's the 12 trailing month non-GAAP earnings per delivery. Still rising on a 12 trailing month basis. It'll take a little step back in Q1 after a couple of lower quarters, Q4 and Q1. Knock that down. And if you just subtract the regulatory credit revenue, here's what the 12 trailing month non-GAAP earnings per delivery would be. That one is still continuing to rise, interestingly. All right, revenue by type. So you've got the income statement look again here, and the costs and expenses by type that I used to make the penny charts we saw earlier in this video. Then more of those, 12 trailing month basis pennies. I've got some date coding here that I use to make charts. Then I've got my non-GAAP operating expense check figures here to make sure I've done this two different ways and that both of those two ways agree to each other. You can calculate it two different ways, and that's what I've done here. Not a lot very exciting to talk about there, just some check figures. Cost of sales percent by income statement line item. This is kind of fun. So leasing is a pretty good deal for Tesla to be a pretty good business for Tesla to be in, but they are taking the risk of needing to take those vehicles back, get them ready for sale, and resell them into the market. And they're not getting the money up front. So on a cash flow basis, leasing is harder for you because you still have to pay your vendors for all the parts and the raw materials you use to build that car. You're just not getting from the person leasing that vehicle all the money up front to pay them back. But Tesla has a virtuous working capital cycle, which is what you want. So Tesla's doing a good job managing cash flows as well as the income statement and the balance sheet. Good work being done by the Tesla finance team. Total automotive cost of sales percentage is higher without regulatory credits than with it. You can see the breakdowns here by model and by site. So for the Texas Model Y and the Berlin Model Y, we know that Tesla was losing money on those at the gross margin level in Q2, but then barely making money in Q3. So I'm forecasting forward that trend to continue. And then for the price cuts in Q1 to hurt a little in Europe. Although that vehicle will still qualify for the local incentives, the $7,000 EV incentives in Europe, which is good news. Non-automotive, so I've got Megapack, for those of you who are curious what I'm forecasting for cost of sales there, improving a lot from Q3 to Q4, and then improving by smaller increments going forward. I also have the other energy, including software as a service, continuing to drive lower and lower costs of sales, and that's the primary driver of why total Tesla energy cost of sales keeps going lower and lower and lower into the future. So I've got that coming down to a 50% cost of sales, 50% gross margin on Megapack by the end of Q4, with really favorable cost of sales on the software portion, because that's the kind of margins you get selling software. Very, very good margins the more software you can sell, which Tesla will continue to sell more of as they sell more Megapacks with auto bidder software. So that gives you gross margins by product and by site. You can see the Fremont Model 3 is not Tesla's most profitable product in any of these quarters, really dipping pretty low in Q4 when the U.S. incentives to take December delivery were very high. That ought to get better in Q1 than it was the last few quarters. Then we've got the Shanghai margins here. Worse in Q4 when they were offering more incentives and free insurance, etc. So this is what I have forecast. Semi is negative and will stay negative for a while before getting a little better and contributing positive gross margin toward the end of 2023. And here it is in total. So regulatory credits are a great business to be in. Super high gross margin, really helping your total gross margin. If you exclude them, your gross margin gets worse, which is what this shows. What else do we have here? Non-automotive gross margins. Negative on solar panels, probably. Small numbers for solar roof. But those ought to get better over time. This next section is giving you some metrics that I used to make that chart on automotive cash sale, excluding leased. Yeah, here's how I made the charts showing the components of operating expense. I even coded this the same as I coded the bars in the chart. Sneak Loki's face into the shot here. People are like, hey, why isn't Loki in the frame? And that takes me to the per diluted share section. So here's where I got all that info that I had to group to put onto the charts because there's too many lines here with too many small dollar amounts. And in particular, the income tax line is negative here, negative 14 cents. You can't chart a negative number, so I had to group a bunch of these costs together to be able to chart that expense. And this is a good check. Every quarter, the number of diluted shares outstanding per diluted share is exactly 1. That's what you want. In your section where everything is on a per diluted share basis. Here's SG&A of 10 cents. I had to group this together. I left myself a note saying that I adjusted the formula so the stack bar chart would work. To explain to my future self why I did that. And here's a section I did to make sure I had good detailed assumptions that add up to what Zach told us, that removing regulatory credits and Austin and Berlin, our operating margin would have been our strongest yet, and auto gross margin would have been nearly 30%. So if you put that together with a couple of other clues that we got, it can help you make sure that your detail makes sense and your totals tie out. So that's how I have small, low single-digit gross margins out of Austin and Berlin in Q3, and I've got those moving to double-digit gross margins in Q4 as both of those factories ramped past 3,000 Model Ys per week of output. And I have already showed you the rest of this. Actually, not quite the rest of it, because I stopped when I got to the total foreign currency impact. I've actually added a new section below that to give total revenue by site and by product. So this is another way of adding up to the total automotive revenue. You can see it by model and by production location. And then below that, I have total Tesla cost of sales by site and by product on here. And what is this good for? It's good for figuring out what the margin impact is, but I'll save that for a future video on rate versus volume versus mix, and explaining why your gross margin is doing what it's doing in total. You need a cause of change is what you need, by model and by site, which I built yesterday, as a matter of fact. Okay, so here's the end. Here is what I'm forecasting for Q4 in the same format that Tesla is going to report it. So you can pause the video here and see how well I did. This is normally on page 3 of the investor letter when it gets released. So you can see how well I did on each of these numbers. And then after all the photos, toward the back, maybe not page 21, sometimes it's page 21, there's a more detailed income statement that gives you all of these numbers. So you can pause this page, check it out, and see how large my forecast variances were versus what Tesla actually reported Wednesday at 4:20 p.m., January 25th. And with that, I think we have reached the end of this video, Loki. Yep. All right, so I'm going to go to my outro screen and say, if you enjoyed today's 1 hour, 17-minute long video, click the like button, leave a comment, tell me what you think. Or you can click the subscribe button if you're not subscribed to my channel yet. And that way you'll see fresh content whenever I post it. Thank you to everyone who supports me, either through Patreon or by joining my YouTube channel, especially my 2 executive producers, Kathy Kitchler and Bradford Ferguson, owner of Halter Ferguson Financial, and I will see you in the next one.